Luskin, the market cheered today, the stock market cheered at this $1 trillion rescue package. Did you cheer?
Well, not really, Larry. Can I please rain on your parade just a little bit?
Yes, please do. That's why we're having you on tonight.
As we speak, at this exact moment, the euro is now trading back where it was trading last week. It's as though this rescue didn't even happen as far as confidence in the eurozone is concerned. And what we are talking about here is a game of confidence. As we learned from TARP, you cannot solve credit crises by throwing money at them. You have to create confidence. The European zone does not have the institutions in place to take this $1 trillion and figure out in any logical way how it's going to be doled out, first to Greece, then to Portugal, then to Spain. How is that going to happen? We don't know that any more than we knew the day that Congress passed TARP. And then Henry Paulson said he was going to do it one way, then he did it another, then Tim Geithner came in and did it yet another. That sheer uncertainty kept the lack of confidence in place for months and months and months in the U.S. banking crisis. And that's what's going to happen in the Eurozone.
Now, so the consumer's coming back. Pending home sales are up more than anyone expected. Car sales last month were up 25% over last year. It doesn't really, you can't really get better data than what we've been seeing.
Don Luskin, do you disagree with James Altucher?
Well, let's see, 9.9% unemployment rate. I think we can get better data. Yeah.
James
but then again, though, jobs are up 4 months in a row. Okay, this is a faster job recovery than in the prior 3 recessions. So
yeah, except in the prior 3 recessions, when we started seeing positive job growth, we started seeing the unemployment rate come down. Well, we just have a more complex reality than you're willing to admit.
This is not going to
be easy. There's good news and bad news happening at the same time, and they're going to average out. This ain't no check mark. It's V-shaped, but it's a V-shaped recovery. It's not a V-shaped expansion.
What we're seeing in the unemployment rate, though, is the fact that people are actually getting confident enough to re-enter the workforce. Why are they getting confident? Because there's more jobs than ever being created. That's what we're seeing.
You would have said the same. You would have said the same thing. You would have said the same thing in 1935. Then they were real confident, waiting in line for jobs.
Well,
but
matter of fact, it's interesting. Gold held up pretty well today, even as the dollar appreciated. So tell me about your gold feelings. Get in touch with your gold feelings with me.
Okay, I'm talking to my inner gold bug now.
Yes.
Larry.
Yes.
Today was a great day for gold for 2 reasons. You know, gold is both cyclically sensitive and inflation sensitive. And by the way, Bob and I share one favorite here, which is Freeport-McMoRan. Great cyclical play, great inflation play. The reason gold did so well today is because the ECB made a terrible inflationary deal with the devil by, for the first time and without legal authority, committing to do quantitative easing. The ECB has never directly bought securities ever in its life, and it's going to do that now. That's number one. Number two,
they folded their hard money
you
cards.
bet they did.
They really did.
You bet they did.
So you may say, they may save the contagion in the short run, but they may sacrifice the euro currency longer term.
That's right. And so if you sacrifice the currency, then gold is going to look better in terms of that currency. The problem is that the Fed did the same thing. By reopening the swap lines for the ECB, the Fed is now going to take its balance sheet to new all-time highs, because when the ECB comes to the Fed asking for dollars, where do you think you're going to get those dollars? All at once. We're going to print them.
All right, so you like the gold play. You're staying with gold.
Love the gold play.
All right, good.